Well, let's get into some themes driving alternative investments now. Mark Sherwood from iPartners joins us. Mark, we are looking, of course, at some measured risks to take, and you're looking at credit. What do you see there as a good return for investors?
Yeah, good morning, Juliet. I think it's a great time to be a credit investor. In fact, it's the greatest time in probably the last 15 years. So we sort of see the outlook for next year in credit even more positive than what it's been in the latter half of this year. That is, with base rates at 4 to 5%. Investment grade credit at 7 or 8% and high yield credit in the mid-teens. There's a huge array of opportunities to consider for the investor. So we really like being a credit investor through next year. I also think that the yields may stay higher for longer than what the markets currently think, and that's really going to play into the part of being a credit investor as well.
So when you say some opportunities, can you give us an indication of what specifically you're looking at here?
Yeah, definitely looking at senior asset-backed lending opportunities. We really like deals where we can fund some of the non-bank lending businesses in Australia. We can take security charge over their book of loans, and we can provide them an ongoing funding source. We like those types of deals because we can closely assess their book of loans. We can assess the credit worthiness of what we're lending to, and we've got direct see-through security to those actual deals. So we're doing a lot in that space, a lot in the private credit space, particularly in senior credit exposures. They're pushing double-digit returns, but they're a very good risk-reward for the investor.
We're looking at the economic downturn, or the impact, of course, of these rates and higher for longer and what that could mean. You're saying that consumer and sectoral exposures will vary greatly. How do you kind of play that amidst the high interest rate environment?
Yeah, I think that's a really important factor in a slowing economy. That's been a factor in recent months, but it's going to be really relevant for next year as well. So that is having a real deep understanding of what segment of the consumer that you might be exposed to, particularly in those asset-backed securities that we often participate in. That's going to be really, really important. We're sort of trying to avoid the most stressed part of the consumer, that is the lower income type earning consumer, because they're really going to be pushed in those personal loans that they might be holding. For us, it's about having that real deep understanding of what part of the economy that we're exposed to, and that is through that lending process.
We are looking as well at some of these higher costs of funding that could be borne by businesses and passed on to the consumer. Just talk us through how you're kind of navigating that amidst an investment environment.
Yeah, I think it's really important when you're looking at a business to understand, does this business have the ability to pass through those higher borrowing costs that they now are occurring, because they're going to hang around for quite a while, irrespective of markets, even maybe anticipating that there could be a rate cut at the latter end of next year. So corporates are going to have to wear these higher borrowing costs for at least the next year, probably the next year and a half to 2 years. So it's really important to have an understanding of is their business model resilient, and does it have the ability to pass through those higher costs perhaps to their output or to their consumer. And those businesses that have that ability are in a much stronger balance sheet position to be able to wear those costs and fund those debt positions that they need to fund to continue to grow their business. So that's an important part of the sort of due diligence criteria that we look at. It's really understanding, is the business going to have to totally absorb these higher borrowing costs, or is there the ability for it to pass it through to their end product?
When we look at the economic softening and the RBA's attempts to kind of stem inflation, do you actually believe that we are going to see some kind of recessionary contraction? Or, to my earlier points, yes, there's still a lot of people out there, particularly the boomers, that are spending?
I think this year's been really interesting in that point, because if you go back at the start of this year, there was so many forecasts, and it's not just Australia, but globally, where you had so many forecasters saying that we'd be in a recessionary environment in the latter half of this year, and it definitely hasn't played out. And that's really come down to a couple of things. One, the consumer has proven to be much more resilient than people probably anticipated, and secondly, that's been driven by employment and obviously some wages growth. So in that light, I don't see us being in a recessionary environment next year. In fact, I think this sort of soft landing talk that we're hearing a lot of is quite relevant. I think the Australian consumer will live more frugally next year. They will try and do their absolute best to absorb their higher mortgage costs, for instance, particularly in the middle class of Australia. There's no doubt though that people are dipping into their savings buffers that they kind of managed to achieve, particularly through the COVID periods. So savings are being eroded, but the consumer is being very, very resilient. I think we're going to continue to see that in the first half of next year. So no, I don't think we're going. I think we're going to avoid a recessionary type environment, but there's no doubt that people will be stretched. And people will do their absolute best to service their debts, essentially.
Yeah, which is already happening. Time to talk your book a little, Mark. You've got a new bond income fund. What are the requirements for this, and why is the time right for such a strategy?
Yeah, absolutely. So we launched this strategy about a month ago, and we do think the timing is really right for what we'd call a high grade bond fund, particularly in the corporate space. This is a bond income fund, which is going to be targeting a minimum of 80% of investment grade bonds, and that will have quite a focus as well on those asset backed securitizations that are done in the public sector, because that's a space that we know very, very well, and we feel we can get some very strong risk reward out of. So it's really about being a core part of an investor portfolio to provide a really stable income source with a very, very high grade portfolio of corporate and asset backed securitization and bonds, and with some really strict criteria around sticking to floating rate note securities. So that is, we're not going to try and pick the yield curve movements as such, and that therefore would come with a higher level of volatility in unit price if we were going down more the fixed rate bond line. So instead, we're really targeting and sticking to floating rate securities, and trying to achieve a consistent credit return that can pay a really strong income to investors and very little price volatility.